Imagine two people sitting at the same table, looking at the same investment. They have access to the same numbers. They can see the same price, the same historical returns, the same economic forecasts, and the same financial statements. One looks at the investment and sees opportunity. The other sees danger. Neither person is necessarily irrational. The first grew up in a family where money was stable. Bills were paid on time. Recessions were discussed at dinner as temporary events. Investing was normal. Market declines were unpleasant, but not terrifying. The second grew up watching a parent lose a job during an economic crisis. Money disappeared quickly. Debt created arguments. Financial uncertainty was not an abstract concept. It was something that changed the atmosphere of the house. Now, these two adults are looking at the same investment, but they are not really looking at the same thing. They are looking at the present through different histories. That is one of the deepest ideas in Morgan Housel's The Psychology of Money. Financial decisions are often presented as mathematical problems. How much should you save? How much risk should you take? Should you buy or rent? What percentage of your portfolio should be invested in stocks? How much money do you need before you can retire? Mathematics matters enormously, but money is never only mathematics. Money passes through human beings, and human beings bring fear, pride, envy, optimism, insecurity, memory, status, patience, regret, family expectations, personal history, and wildly different ideas about what constitutes enough. This is why someone can understand finance intellectually and still behave terribly with money, and why another person with little formal financial education can quietly build substantial wealth. The spreadsheet may tell you what is mathematically optimal. It cannot guarantee that you will actually live according to the spreadsheet. Financial success, therefore, depends on something more subtle than knowing the correct formula. It depends on developing behavior that can survive uncertainty. And survival may be the most underrated financial skill of all. Consider a simple example. Suppose you have $100,000 invested. You discover a strategy that has the potential to produce extraordinary returns. You become convinced that the opportunity is unusually good, so you borrow heavily and invest even more. Your analysis turns out to be correct, eventually. But before the investment rises, its value falls dramatically. Because you borrowed money, you cannot wait indefinitely. Your lender demands payment. You are forced to sell. 6 months later, the investment recovers and eventually reaches the price you originally predicted. Were you right? In one sense, yes. Your forecast was accurate. Were you financially successful? No. You were right in a way you could not survive. This distinction is fundamental. In finance, being correct about the long run is not enough if your strategy can destroy you in the short run. A plan that requires everything to go approximately right is fragile. A plan that can tolerate mistakes, bad timing, recession, illness, job loss, unexpected expenses, and emotional stress has something more valuable than theoretical efficiency. It has endurance. And endurance gives compounding time to work. Compounding is usually explained with numbers. Invest money, earn a return, leave the gains invested. Then future returns occur on a larger base. Over long periods, the results can become enormous. But the mathematical explanation hides a psychological requirement. To receive the benefits of long-term compounding, you must remain in the game long enough for the long term to arrive. That sounds obvious. It is not easy. The world does not deliver compound growth in a smooth line. Markets fall, businesses fail, jobs disappear, emergencies happen, people panic, people become greedy. A neighbor gets rich faster, a friend buys a bigger house, a new investment becomes fashionable, a terrifying headline predicts disaster, a euphoric headline predicts endless prosperity. The mathematics of compounding may be simple. The behavior required to experience it can be extraordinarily difficult. Imagine planting a tree that grows very slowly for its first decade. Every year you measure it. The progress seems disappointing. Your neighbor plants a different tree that grows quickly. You become impatient. You consider replacing yours. Then someone tells you about a new species that supposedly grows twice as fast. You dig up your tree and plant the new one. 3 years later, another trend appears. You replace it again. After 20 years, you have become highly active. You have researched constantly. You have made many decisions. You have responded quickly to new information. and you still have no large tree. Someone else planted a reasonable tree 20 years ago and mostly left it alone. That person may look passive, but patience was doing work. This is one of the paradoxes of money. Action is visible. Patience is invisible. We naturally associate effort with activity. If you want better results, you should do more. That logic works in many areas. If your kitchen is dirty, cleaning more helps. If you do not understand a subject, studying more can help. If you are learning piano, practice matters, but investing can punish unnecessary activity. Sometimes the intelligent action is not acting. Sometimes the most important financial decision this month is continuing the decision you made years ago. This does not mean people should never change investments or update plans. It means activity and progress are not the same thing. The desire to constantly improve a portfolio can become an obstacle if it repeatedly interrupts a sound long-term strategy. Patience, however, requires something psychologically difficult. You must tolerate other people appearing to get rich faster. Imagine that you and a friend begin investing at the same time. You choose a diversified, relatively boring approach. Your friend concentrates heavily in a speculative asset. For 3 years, your friend's investment rises dramatically. Every conversation becomes uncomfortable. You start feeling foolish. Your strategy may still be appropriate for your goals and risk tolerance, but now you face a different kind of risk. Social risk. The risk of looking wrong while someone else looks right. This can be more powerful than financial theory acknowledges. People do not experience wealth privately. We compare. The person with $1 million may feel successful until spending time with people who have 10 million. Someone driving a perfectly reliable car may feel satisfied until coworkers begin arriving in luxury vehicles. A family may love their house until friends move into a larger neighborhood. Nothing about the original possessions changed. The comparison changed. Money is therefore partly a social experience, and social comparison can quietly redefine enough. This brings us to one of Housel's most important distinctions. Wealth is not the same as visible spending. Suppose you see someone driving an extremely expensive car. What do you actually know about their financial position? Very little. You know they obtained access to an expensive car. Perhaps they are extremely wealthy. Perhaps they financed almost the entire purchase. Perhaps they have substantial investments. Perhaps they have almost no savings. Perhaps the car represents a tiny fraction of their net worth. Perhaps the monthly payment creates constant stress. The visible object does not reveal the invisible balance sheet. This seems obvious when stated directly. Yet human beings routinely infer wealth from consumption. The difficulty is that actual wealth is often what you do not see. The money that was not spent, the investment account that does not appear in photographs, the house that could have been larger but was not, the car that was kept for another 5 years, the bonus that disappeared into savings instead of becoming a vacation, the increase in income that did not produce an equal increase in lifestyle. Visible consumption displays spending. Wealth often consists of unspent options. This creates a strange social problem. People sometimes buy expensive things because they want admiration. But when you see someone driving a beautiful car, what do you usually think? You may think, that is an amazing car, or I would love to own that. You are thinking about yourself possessing the object. You may not be admiring the owner nearly as much as the owner imagines. This can turn status consumption into a psychological misunderstanding. Someone buys an object hoping other people will think highly of them. Other people mostly imagine how they themselves would feel owning the object. The admiration attaches to the possession more than the person. None of this means expensive purchases are wrong. If someone loves cars and can comfortably afford one, an expensive car may provide genuine enjoyment. Money is meant to serve life. The problem begins when consumption is used as a scoreboard for identity. Then spending can become infinite because status has no natural finish line. There is always a better car, a larger house, a more exclusive neighborhood, a more expensive watch, a more luxurious vacation, a higher level of access. If the objective is to have more than other people, enough becomes mathematically impossible. Someone will always have more. This is why the concept of enough matters. Enough does not mean rejecting ambition. It does not mean living without comfort. It does not mean pretending money is unimportant. Enough means understanding when additional financial reward is no longer worth the additional risk required to obtain it. Imagine someone with $20 million. Their family is secure. Their lifestyle is comfortable. They have more than enough resource for everything they genuinely value. Then they discover an opportunity to potentially turn 20 million into 100 million. The opportunity requires risking almost everything. Mathematically, the upside is enormous. Psychologically, the question is different. What can the additional 80 million provide that is worth risking the security already achieved? If the answer is primarily status, competition, or the inability to stop playing, the person may be risking something essential for something unnecessary. There is no universal number called enough. That is precisely the challenge. Enough is personal. One person may feel financially free with modest expenses and a small home. Another may have responsibilities requiring far more. A family caring for relatives has different needs from an individual with no dependents. Someone living in an expensive city faces different costs from someone living in a low-cost region. Someone with unstable employment may reasonably want a larger financial buffer. Someone with secure income and strong social support may need less. Enough cannot be copied from another person's spreadsheet. It must emerge from the life the money is meant to support. This points toward another major theme. Financial decisions are personal because financial histories are personal. Imagine someone born in 1950 and someone born in 1990. Even if they study the same historical data, their emotional experiences with markets may be completely different. One generation may have formative memories of inflation. Another may have experienced decades in which falling interest rates and rising asset prices felt normal. One person enters adulthood during a booming economy. Another graduates during a recession. One buys a home before property prices surge. Another tries to enter the housing market after years of appreciation. These experiences influence beliefs, not because people are stupid, because personal experience feels more real than abstract history. Suppose someone invests their first significant savings immediately before a major market crash. They watch years of accumulated money decline rapidly. Even if they understand intellectually that markets eventually recover, the experience can shape them for decades. Another person begins investing at the start of a long bull market. Their early decisions are rewarded. Risk feels productive. Confidence grows. Both people may later tell stories about what investing is really like, but each has observed a tiny slice of financial history. This is one of the central psychological problems of money. We learn from experience, yet individual experience is an extremely small sample. Your personal financial history might cover several decades. The economic world is shaped by centuries of technological change, war, political shifts, inflation, innovation, demographic change, regulation, financial crises, and unpredictable events. No individual experiences all possible environments. We therefore build universal beliefs from local histories. The person traumatized by a crash may become permanently too conservative. The person enriched by a boom may become permanently too aggressive. Both can confuse what happened to them with what always happens. This is why financial disagreement is often more understandable than it appears. Two intelligent people can examine the same facts and reach different conclusions because they are solving different psychological problems. For one person, the worst imaginable outcome is losing purchasing power because money sits in cash. For another, the worst imaginable outcome is watching investments fall by 40%. For one, volatility is an opportunity. For another, volatility means sleepless nights. If a strategy is theoretically optimal, but causes you to panic and abandon it at the worst possible moment, it was never optimal for you. This is an important correction to purely mathematical finance. The best strategy is not necessarily the strategy with the highest expected return. It may be the best strategy you can realistically maintain. That introduces the difference between reasonable and rational. Imagine a perfectly rational financial model. It calculates that you need only a certain amount of emergency cash because the expected return on investments is higher than the return on cash. Mathematically, holding additional cash may be inefficient. But suppose having 12 months of expenses in a savings account allows you to sleep well, stay invested during market declines, negotiate more confidently at work, and avoid selling investments during emergencies. The cash may be mathematically suboptimal while behaviorally excellent. A spreadsheet sees idle money. A human being sees independence. That independence has value. This is one reason financial planning cannot be reduced to maximizing returns. Returns are only one variable. There is also resilience, flexibility, liquidity, stress, time, autonomy, the ability to survive mistakes, the ability to change direction, and perhaps most importantly, the ability to control more of your own life. Money's greatest value may not be the objects it buys. It may be the control it gives you over time. Imagine two people with identical salaries. One spends almost everything they earn. The other spends considerably less and gradually builds savings. The first may have the more impressive lifestyle, but the second is accumulating something invisible. The ability to say no. No to a terrible job. No to an unreasonable client. No to staying in a city they dislike. No to working until an arbitrary retirement age. No to tolerating every emergency as a catastrophe. Savings create distance between what happens to you and what you are forced to do next. That distance is freedom. This helps explain why saving money can make sense even without a specific purchase in mind. Traditional financial thinking often asks what you are saving for. A house, a car, retirement, education, a vacation. Those are reasonable goals. But savings can also be valuable precisely because the future is unknowable. You save for things you cannot currently name. Imagine being asked 10 years ago to list every major expense, opportunity, crisis, and life change you would experience during the next decade. You would miss many of them. A career opportunity in another city, a family emergency, a new relationship, an illness, a business idea, a period of unemployment, a chance to take several months away from work. The future contains possibilities that cannot all be scheduled. Savings buy optionality, and optionality becomes more valuable when uncertainty is high. This leads naturally to risk. Risk is often treated as volatility. An investment moves up and down. The larger the fluctuations, the riskier it appears. But from a personal perspective, risk has another meaning. Risk is whatever prevents you from reaching the future you need. For a young investor with stable income and decades ahead, temporary market declines may be uncomfortable but survivable. For someone who needs the money next year to pay for a home, the same decline could be disastrous. The asset is identical. The personal risk is different. Time horizon matters. Cash flow matters. Obligations matter. Psychology matters. This is why universal rules become dangerous. Stocks are good. Debt is bad. Renting is wasting money. Buying a house is always smart. Cash is useless. Everyone should maximize retirement contributions. Never pay off low-interest debt early. These statements can contain useful principles, but financial decisions exist inside circumstances. Debt used to purchase a productive asset is different from debt used to finance a lifestyle someone cannot afford. A mortgage can be reasonable for someone planning to remain in one place for decades and inappropriate for someone expecting to move soon. Renting can provide valuable flexibility. Buying can provide stability. Cash can lose purchasing power to inflation while simultaneously providing emergency resilience. Paying off a low-interest loan early may be mathematically inferior to investing, but emotionally valuable to someone who strongly values being debt-free. Personal finance becomes distorted when optimization ignores the person. The goal is not to produce the mathematically perfect human. The goal is to build a financial life a real human can sustain. This is particularly important when discussing risk tolerance. People often estimate their risk tolerance when markets are calm. Imagine sitting comfortably at home and answering a questionnaire. If your portfolio fell 30%, what would you do? You select, I would buy more. It feels sensible. Then a real crisis happens. Your portfolio falls 30%. But now the decline is not a hypothetical red line on a questionnaire. Your company is announcing layoffs. The news is showing collapsing businesses. A friend has lost their job. Experts are debating whether the financial system is in danger. Your partner is worried. You have no idea whether the market will fall another 30%. Suddenly, your true risk tolerance looks different. Risk cannot be understood completely in advance because the emotional experience of uncertainty is difficult to simulate. This is why a margin of safety matters. A margin of safety means creating room for the possibility that your assumptions are wrong. Suppose you calculate that you can comfortably afford a house if everything proceeds approximately as expected. Your salary continues. Interest costs remain manageable. Repairs are ordinary. Monthly expenses stay near current levels. Technically, the numbers work. But what if the roof needs replacing? What if your income falls? What if a family member needs financial help? What if taxes rise? What if you simply discover that you dislike spending such a large percentage of your income on housing? A margin of safety does not require predicting which problem will occur. It acknowledges that some problem eventually will. This is one of the most important forms of humility in finance. You do not need to know exactly what will go wrong. You need to build a plan that does not require nothing to go wrong. This is closely connected to room for error. Imagine planning a road trip of 500 miles. Your car theoretically has enough fuel to travel exactly 510 miles. Would you begin the trip without stopping for fuel? Probably not. You understand instinctively that theoretical capacity and practical safety are different. Traffic happens, detours happen, weather happens. Estimates are imperfect. Financial plans deserve the same humility. Yet people often optimize their finances until no room remains. Every dollar of income is assigned. Every projection assumes expected returns. Every debt payment depends on stable employment. Every future milestone assumes the plan continues without interruption. This can look efficient. It is also fragile. A resilient financial life contains slack. Slack can feel wasteful during good times. Then bad times arrive, and the waste reveals itself as insurance. Insurance itself is an interesting psychological concept. If you pay for insurance for 20 years and never make a claim, was the money wasted? Only if you misunderstand what you purchased. You purchased protection against a possibility. The fact that the possibility did not occur does not mean protection had no value. The same logic applies to many conservative financial choices. An emergency fund can sit unused for years. A diversified portfolio can underperform the hottest investment. A lower level of debt can reduce potential returns during a boom. A margin of safety can look inefficient right up until the moment it becomes necessary. Good financial decisions can therefore look foolish for long periods. This makes them psychologically difficult. You need the ability to tolerate looking wrong. That ability becomes especially important because financial outcomes are shaped by luck. Luck is uncomfortable to discuss. Successful people often prefer stories about skill. Unsuccessful people may prefer stories about bad luck. Reality usually contains both. Imagine two equally talented entrepreneurs. Both work hard. Both understand their industries. Both launch promising companies. One happens to enter the market shortly before a technological shift that creates enormous demand. The other launches before a recession destroys customer budgets. Years later, the first is celebrated as a visionary. The second disappears from public attention. Skill mattered. So did timing. Now reverse the perspective. Suppose someone takes a reckless financial risk and becomes rich. The outcome can make the behavior look intelligent. A second person takes the same risk and loses everything. The behavior is condemned. But if the original decisions were nearly identical, we should be cautious about learning opposite lessons merely because luck produced opposite outcomes. This is difficult because we see outcomes more clearly than probabilities. Success is visible. The alternative histories are invisible. A billionaire exists in front of us. The thousands of people who made similar decisions and failed are scattered and forgotten. This is survivorship bias. It can make extreme success look more reproducible than it is. Suppose you study 10 spectacularly successful investors. You discover that all 10 were unusually concentrated in their investments. You conclude that concentration is the secret. But perhaps thousands of equally concentrated investors lost most of their money and disappeared from your sample. Studying winners alone can transform survivorship into strategy. The lesson is not that successful people are merely lucky. That would be equally simplistic. The lesson is that outcomes usually combine controllable and uncontrollable forces. Skill changes probabilities. Luck influences which possibility becomes reality. Recognizing this should change how we judge both success and failure. Admire good decisions without assuming every good outcome was deserved. Learn from failure without assuming every bad outcome proves incompetence. And perhaps most importantly, do not copy another person's risk merely because you envy their result. You may be seeing the winner of a game you cannot afford to lose. This brings us back to survival. Imagine two investors. Investor A is brilliant and aggressive. They produce extraordinary returns for 12 years. In year 13, one enormous leverage bet goes wrong and wipes them out. Investor B is less impressive. Their returns are good, but never spectacular. They diversify. They maintain cash. They avoid risks capable of destroying the portfolio. After 40 years, Investor B is still investing. Who had the better strategy? That depends on what you measure. If you select certain years, Investor A looks superior. If the objective is long-term wealth, survival becomes part of the return. You cannot compound money that no longer exists. This is why avoiding ruin has special importance. Most mistakes are recoverable. Ruin is different. If an investment falls 10%, you can recover. If you miss an opportunity, another may appear. If your prediction is wrong, you can update. But if you take a risk that permanently removes you from the game, future opportunities no longer matter. This creates an asymmetry. You do not need to avoid all risk. You need to avoid risk that prevents you from continuing. This principle applies beyond investing. A business can tolerate many failed experiments if no single experiment threatens its existence. A career can tolerate mistakes if you preserve reputation, relationships, and adaptability. A household can tolerate unexpected expenses if debt and fixed costs leave room. Resilience is not the absence of failure. It is the ability to continue after failure. That makes financial flexibility extraordinarily valuable. Imagine choosing between two jobs. Job A pays slightly more, but requires you to build a lifestyle around the higher salary. Expensive housing, large monthly commitments, a costly commute. Job B pays somewhat less, but your expenses remain low enough that you can save consistently. On paper, Job A has the higher income, but income is not wealth. What matters is the gap between what comes in and what must go out. High income with equally high obligations can produce little freedom. Moderate income with substantial savings can produce increasing control. This is why lifestyle inflation deserves attention. You receive a raise. At first, you feel richer. Then you upgrade the apartment. You replace the car. Restaurants become more expensive. Vacations become more elaborate. Subscriptions multiply. Within a year, the new income feels normal. Your lifestyle has absorbed the raise. Nothing is inherently wrong with enjoying higher income. The problem occurs when every increase in earnings immediately becomes an increase in fixed expectations. Then financial success fails to produce financial freedom. The person earns more, but needs more. The treadmill accelerates. The psychological concept of enough offers an exit. What if some portion of future income growth did not need to become visible lifestyle growth? What if earning more increased the gap between what you could spend and what you chose to spend? That gap becomes wealth, and wealth creates options. The distinction between rich and wealthy is useful here. Rich can describe high current income. Wealth describes accumulated resources not yet spent. A professional earning $500,000 annually may appear rich. If they spend $520,000, their financial position may be fragile. Someone earning far less but saving consistently may have greater resilience. Again, what is visible can be misleading. Income is easier to display than net worth. Consumption is easier to display than restraint. The social world therefore provides distorted financial examples. We see houses. We do not see mortgages. We see vacations. We do not see retirement accounts. We see cars. We do not see emergency funds. We see luxury. We do not see anxiety. This makes comparison dangerous because we compare our complete financial reality with the visible surface of someone else's. It is like comparing the backstage of your life with the advertisement for theirs. The solution is not to stop noticing other people. Comparison is deeply human, but we can become more careful about what conclusions we draw. Someone else's spending tells you almost nothing about what you should spend. Someone else's portfolio tells you little without knowing their time horizon. Someone else's appetite for risk tells you little without knowing their obligations. Someone else's financial goal may have nothing to do with yours. This is why personal finance is personal in a deeper sense than the phrase usually implies. Your financial plan should reflect what you value. Suppose one person wants to maximize lifetime wealth, another wants to retire early, another loves their career and expects to work into old age. Another wants enough flexibility to spend several years raising children. Another wants to support aging parents. Another wants to build a company. Another values travel more than home ownership. Another values geographic stability. These people should not necessarily make identical financial decisions. There is no single optimal portfolio independent of the life the portfolio serves. Financial advice becomes dangerous when it forgets the objective. Consider home ownership. For some people, buying a house can be financially and emotionally valuable. It provides stability, control over living space, and potential long-term appreciation. For others, renting can provide flexibility, lower responsibility for repairs, and easier mobility. If someone expects to move frequently for work, buying may create friction. If someone deeply values staying in one community, ownership may provide benefits that cannot be reduced to investment returns. The question, is buying better than renting, is incomplete. Better for whom? For how long? At what price? With what alternatives? Under what emotional preferences? The same is true of debt. Some people view all debt as dangerous. Others treat debt as a useful tool. Both perspectives can make sense depending on context. Debt can increase opportunity. It can also reduce flexibility. A mortgage payment is not merely an interest rate. It is a future obligation. The larger your fixed obligations, the fewer choices you may have when circumstances change. This does not make debt inherently bad. It makes debt a trade. You receive something now in exchange for claims on future income. Whether that trade is wise depends partly on how predictable the future is. And the future is never completely predictable. This is where pessimism and optimism enter financial thinking. Pessimism often sounds intelligent. A prediction of disaster attracts attention. Everything will be fine over the long run sounds naive. An unprecedented crisis is coming sounds sophisticated. There is a reason. Bad events can happen quickly. Good progress usually happens slowly. A market can collapse in days. A recession can eliminate jobs in months. A company can fail suddenly. But technological improvement, productivity growth, education, infrastructure, and compounding often unfold over years. Destruction is dramatic. Progress accumulates quietly. Imagine a city where living standards improve gradually for 20 years. Homes become safer. Medicine improves. Technology becomes cheaper. Transportation becomes more efficient. People barely notice from one year to the next. Then a financial crisis occurs. Within weeks, fear dominates every conversation. The crisis is real, but the asymmetry of attention can make short-term destruction feel more fundamental than long-term progress. A useful financial worldview may therefore combine short-term caution with long-term optimism. Expect problems, prepare for recessions, assume investments will sometimes fall, assume forecasts will fail. Maintain a margin of safety, but also recognize that human beings adapt, innovate, rebuild, and solve problems. Optimism without caution becomes recklessness. Pessimism without optimism makes long-term investment almost impossible. The balance is subtle. You can believe that the future will probably improve while admitting that the path will be chaotic. In fact, those ideas belong together. Long-term progress often contains short-term disaster. Consider the history of markets. Growth does not happen because nothing bad occurs. Growth happens despite bad things occurring. This is psychologically difficult because when the bad thing is happening, the long term becomes hard to imagine. A market decline on a historical chart looks like a temporary valley. Living through one feels different. The chart does not show fear. It does not show layoffs. It does not show arguments between spouses. It does not show the investor wondering whether this time is fundamentally different. Historical returns are clean. Historical experience was messy. This is why long-term investing requires more than knowing history. It requires emotionally surviving the present. And that leads to an important idea. Volatility can be understood as a price rather than a punishment. Suppose long-term investments offer the possibility of higher returns, partly because investors must tolerate uncertainty and fluctuations. Then market declines are not necessarily evidence that something has gone wrong. They may be part of what you are paying for the possibility of higher long-term returns. Imagine buying a ticket to an amusement park. You pay the admission fee. You do not stand at the entrance complaining that the park should be free. That the price is part of the experience. Investment volatility can sometimes be thought of similarly, not as a fine imposed on you for making a mistake, but as a cost attached to uncertain returns. Of course, this metaphor has limits. Some investments fall because the underlying asset is genuinely deteriorating. Not every decline should be ignored. The point is psychological. If you interpret every temporary loss as evidence of failure, you may be unable to hold assets whose long-term returns necessarily involve short-term uncertainty. You need to know which discomfort is part of the plan and which discomfort signals that the plan is broken. That distinction requires judgment. No slogan can make it automatically. This is another reason universal financial rules are limited. Never sell during a downturn sounds wise until the investment is a failing company whose fundamentals have collapsed. Always hold for the long term works only if the thing you hold remains worth holding. Buy the dip sounds clever until the dip becomes permanent decline. General principles need context. Diversification can help precisely because we cannot reliably know which specific future will occur. Imagine planting a garden with only one crop. If conditions are perfect for that crop, the harvest is extraordinary. If disease attacks it, everything is lost. A diversified garden may never produce the maximum possible harvest under ideal conditions, but it is more likely to produce something under many conditions. Diversification accepts that we do not know the future. This can feel unsatisfying because concentrated success creates spectacular stories. Nobody writes dramatic headlines about the person who became financially secure through 30 years of diversified investing, moderate spending, and consistent saving. The story lacks fireworks, but boring can be powerful. Many successful financial behaviors are boring. Spend less than you earn, save consistently, avoid catastrophic risk, invest for long periods, keep costs reasonable, diversify, allow room for error. Do not let other people's lifestyles determine your needs. None of this sounds like a secret. That is the point. Knowing what to do and actually doing it for decades are completely different achievements. Financial behavior becomes especially difficult when incentives change. Imagine someone who accumulates enough money to become financially independent. For 30 years, their skill was saving. Do not spend, accumulate, delay gratification. Then retirement arrives. Now the skill required is different. Spend, use the money, accept that the account may decline. Enjoy what was accumulated. Some people find this psychologically difficult. The habits that created wealth can make wealth difficult to use. This reveals a larger truth. No financial behavior is universally correct across every stage of life. Saving can become hoarding. Frugality can become deprivation. Risk-taking can become recklessness. Caution can become paralysis. Ambition can become endless competition. Financial wisdom requires adaptation. The strategy should serve the life, not the other way around. This also raises a philosophical question. What is money for? It sounds simple. Money buys things. But many of the most valuable things money provides are not things. It can buy time. It can reduce dependence. It can create choices. It can allow you to leave. It can allow you to wait. It can let you help someone. It can absorb an emergency. It can make a career change possible. It can allow you to spend Tuesday afternoon with your child without asking permission. This is why control over time may be one of money's highest forms of value. Imagine someone with a beautiful house, expensive possessions, and a prestigious job. They also have enormous fixed expenses. They cannot reduce working hours. They cannot risk changing careers. They cannot take 6 months away. Their lifestyle is wealthy in objects, but poor in flexibility. Now imagine someone with a more modest lifestyle and several years of expenses saved. They may possess fewer impressive things, but they possess greater control over tomorrow. Which person is richer? The answer depends on what money means. If money is a tool for displaying success, perhaps the first. If money is stored freedom, perhaps the second. Housel's framework pushes us toward the second interpretation. Savings are not merely deferred consumption. They are accumulated autonomy. But even this principle has limits. It would be wrong to turn saving into a moral virtue independent of circumstance. A person with very low income may have little ability to save after housing, food, healthcare, transportation, and family responsibilities. Telling such a person that wealth is simply a matter of discipline ignores economic reality. Behavior matters. So do wages, housing costs, healthcare systems, education, inheritance, family support, taxation, geography, discrimination, and luck. Personal finance lives inside an economic environment. Psychology does not replace economics. The strongest interpretation of the psychology of money is not that behavior explains everything. It is that behavior explains more than traditional financial discussions sometimes acknowledge. This distinction matters. If someone inherits $1 million, behavior did not create the initial wealth. Behavior will influence what happens next. If someone grows up in poverty, excellent habits may improve their position without erasing structural disadvantages. If someone experiences catastrophic illness, financial planning can provide protection but may not eliminate the economic damage. Agency matters. Constraints matter too. Good financial thinking should hold both truths at once. This becomes especially important when people use financial success as evidence of moral superiority. Wealth can reflect skill, discipline, patience, and hard work. It can also reflect timing, inheritance, social networks, geography, opportunity, market conditions, and luck. Poverty can involve poor decisions. It can also involve circumstances no budgeting technique can easily overcome. Money is too complex for simple moral stories. The same humility should apply when giving advice. Suppose an investor achieved extraordinary returns by taking enormous risks. They may sincerely recommend those risks to others. But their advice contains a hidden problem. They are speaking from the branch of reality in which the risk succeeded. Someone who took the same risk and was ruined may no longer have an audience. This is why copying successful people can be dangerous. Their outcome does not tell you the full distribution of possibilities they faced. Ask a different question. If I repeated this strategy 100 times across different possible futures, how often would I survive? That is a more useful way to think about risk, not, can this work? Many dangerous strategies can work. Ask, what happens when it doesn't? Imagine investing all your money in a single promising company. Could it make you wealthy? Absolutely. Could the company also fail? Yes. The relevant question is not whether success is possible. It is whether failure would be acceptable. This shifts financial thinking from maximizing upside toward managing downside. Again, that does not mean avoiding risk. Avoiding all risk creates other risks. Holding all wealth in cash exposes you to inflation. Never changing jobs can expose you to career stagnation. Never investing can make long-term goals harder. Risk cannot be eliminated. It can only be chosen. This is a more mature definition of safety. Safety is not the absence of uncertainty. It is having the capacity to endure the uncertainties you choose. A diversified investor accepts market volatility. A business owner accepts income uncertainty. A homeowner accepts maintenance costs. A renter accepts rent increases and less control over the property. Every financial arrangement contains risk. The question is which risks you understand, which risks you can survive, and which risks are worth taking for the life you want. This is why personal history matters again. One person's tolerable uncertainty is another person's nightmare. Someone whose parents lost their home may place enormous emotional value on paying off a mortgage early. A financial model might say that investing extra money could produce higher expected returns. But the model cannot measure exactly what debt-free ownership means to that person. Peace of mind is difficult to enter into a spreadsheet. It is still real. At the same time, personal history can also trap us. The person traumatized by debt may avoid every form of borrowing, including potentially productive borrowing they could safely manage. The person who watched a parent become wealthy through real estate may become overconfident that property always rises. The person who experienced a long bull market may underestimate crashes. History teaches. History also biases. Wisdom requires asking which lessons from our past are general and which belong specifically to the environment in which we learned them. This is difficult because emotional lessons feel universal. A child who sees money cause family conflict may grow into an adult who avoids discussing finances. Someone raised in extreme frugality may feel guilty spending even when financially secure. Someone raised around lavish consumption may experience ordinary restraint as deprivation. Someone whose family treated wealth as status may continue using money to seek social approval. These are not merely investment preferences, they are money scripts. Stories about what money means: security, power, love, freedom, respect, danger, shame, success, control. A financially intelligent life therefore requires some psychological archaeology. When you feel fear around money, what exactly are you afraid of? When you want an expensive object, what do you expect the object to change? When you resist saving, what does saving feel like you are giving up? When you obsessively save, what future catastrophe are you trying to prevent? When someone else becomes richer, why does their success change how you feel about your own life? The numbers matter, but the emotional meaning attached to the numbers often determines behavior. Consider a person who reaches a financial goal they have pursued for 10 years. They expect it to feel secure. Instead, within months, they create a new goal twice as large. Then another. Security never arrives. Why? Perhaps the problem was never the number. Perhaps money was being asked to solve an emotional problem that numbers cannot permanently solve. If wealth is being used to eliminate all uncertainty, no amount may feel sufficient because life remains uncertain. If wealth is being used to prove personal worth, someone richer will always exist. If wealth is being used to guarantee admiration, admiration remains unstable. Money can solve many problems. It cannot solve every problem. Knowing what money cannot do may be as important as knowing what it can. This is where the idea of enough becomes profound. Enough is not a financial calculation alone. It is a boundary between using money and being used by the pursuit of money. Imagine a game where winning gives you 10 points. After winning, however, the scoreboard automatically moves the target to 20. Reach 20 and the target becomes 50. Reach 50 and it becomes 100. There is no final victory because the definition of victory changes with your score. That is what status competition can do to wealth. The only way to win is to define your own finish line. Not necessarily a point where you stop working. Not a point where ambition disappears. A point where you know what you refuse to risk for more. Your health, your closest relationships, your integrity, your independence, your ability to sleep, your freedom from catastrophic loss. Without such boundaries, financial ambition can consume the very life money was supposed to improve. Patience becomes easier when enough is defined. So does compounding. If you are constantly chasing the highest possible return, ordinary long-term returns feel disappointing. If your plan only requires reasonable returns sustained for a long time, you gain a powerful advantage. You do not need to be brilliant very often. You need to avoid being catastrophic. This is a different model of financial success. It replaces constant optimization with endurance. Imagine two paths. On the first, you earn spectacular returns for 5 years, then lose almost everything. On the second, you earn moderate returns for 30 years. Human attention is attracted to the first path during its spectacular phase. Compounding rewards the second. Time is the hidden multiplier, and time works best when it is uninterrupted. This makes patience an active financial strategy. Patience does not mean ignoring reality. It means refusing to demand that reality follow your preferred schedule. A good investment can disappoint for years. A career can progress unevenly. A business can grow slowly before reaching scale. Savings can feel insignificant for a long time. Compounding often hides its most important work in the period when the results seem unimpressive. This is psychologically difficult because humans prefer visible feedback. If effort produces no obvious result, we question the effort. But many financial processes have long delays. Imagine filling a large container 1 cup at a time. For a long time, the container looks mostly empty. Near the end, each additional cup appears more significant because the accumulated volume is finally visible. The early cups mattered just as much. They simply did not look dramatic. Compounding creates similar optical illusions. Late-stage results attract attention. Early-stage persistence created the conditions. This is why starting earlier can matter so much. Not because youth has magical investment powers, but because time allows repeated returns to interact. Yet even here, universal advice requires caution. Start investing as early as possible is generally useful. But a 22-year-old with high-interest debt, Unstable housing and no emergency savings may have priorities that come first. Financial rules live inside hierarchies of needs. A principle can be broadly true without being universally applicable at every moment. The same applies to saving rates. Saving more usually increases financial resilience, but maximizing savings at all costs can become absurd. Imagine someone who refuses every meaningful experience with family for 40 years because spending any money feels irresponsible. At retirement, they possess substantial wealth but cannot recover the lost time. A financial plan succeeded. A life may not have. The purpose of saving is not to maximize the number in an account. It is to transfer resources from moments when money is less valuable to moments when it is more valuable. Sometimes that means moving money from today to the future. Sometimes the present is the moment when money has extraordinary value. A once-in-a-lifetime family gathering, time with aging parents, education that opens possibilities, healthcare, a necessary period of rest. Financial wisdom requires judgment about time, not merely accumulation. This is why rules such as never touch principal or always save a fixed percentage can be useful defaults, but poor commandments. Life changes, values change, opportunities change. Financial plans should contain principles strong enough to provide stability and flexibility, strong enough to accommodate reality. The same is true of retirement. Some people imagine retirement as the ultimate financial goal, but retirement is not a universal desire. Someone who loves their work may prefer gradually reducing hours rather than stopping. Another person in physically exhausting work may desperately need an earlier exit. Someone may want financial independence not to stop working, but to choose work without needing the salary. The deeper objective is often autonomy, the ability to make decisions without every choice being dominated by immediate financial necessity. That is why the relationship between wealth and freedom is so important. Wealth is stored possibility, not infinite possibility, but more room to choose. This perspective can change how we think about spending. Every purchase has two prices. There is the visible price in money, and there is the invisible price in future flexibility. Spend $100 today, and you lose not only the $100, but whatever options that money might have supported later. That does not make spending bad. If taken too far, this logic could justify never enjoying anything. The point is simply that consumption and freedom compete for the same resources. Every person must decide where the balance belongs. There is no formula that can tell you exactly how much present enjoyment should be exchanged for future flexibility. That is a values question disguised as a financial question, and values cannot be outsourced completely. This is perhaps why financial advice so often becomes contradictory. One expert says to enjoy your money because life is short. Another says to save aggressively because the future is uncertain. Both are right. Life is short. The future is uncertain. The tension cannot be eliminated. It must be managed. Good financial behavior exists between extremes. Enjoy today without assuming tomorrow does not matter. Prepare for tomorrow without treating today as disposable. Take enough risk to create opportunity. Avoid enough risk to survive. Use optimism to invest. Use pessimism to prepare. Learn from history. Do not assume history will repeat exactly. Admire success. Remember luck. Analyze failure. Remember bad luck. Build wealth. Do not confuse wealth with visible consumption. Set goals. Leave room for a future you cannot predict. These are not contradictions to be solved. They are tensions to be balanced. That may be the deeper reason money is psychological. Mathematics prefers precise answers. Life often requires trade-offs. Consider the idea of financial independence. At first it sounds like a number, perhaps 25 times annual expenses, perhaps some other target. But beneath the number is a psychological question. What do you want independence from? A job you dislike? Fear of emergencies? Dependence on family? The pressure to impress other people? The inability to control your schedule? Different answers create different financial strategies. If your main goal is freedom from a stressful career, lowering expenses may be as powerful as increasing investment returns. If your main goal is family security, insurance and liquidity may matter more than maximizing portfolio growth. If your goal is flexibility, avoiding excessive fixed costs may be central. The number follows the purpose. Without purpose, financial optimization can become an endless game. And endless games are dangerous because there is always another level. This returns us to the two people at the table. Same investment, same numbers, different histories. One sees opportunity, one sees danger. What should they do? There is no universal answer. They should understand the mathematics. They should understand the risks. They should consider alternatives. They should distinguish temporary volatility from permanent loss. They should think about time horizon, liquidity, diversification, taxes, costs, and expected returns. But after all of that, another question remains. Which decision can each person actually live with? Not for a week, not while markets are rising, for years, through uncertainty, through comparison, through frightening headlines, through moments when someone else appears smarter, through periods when the strategy seems not to work. The best financial plan is partly the one that survives its owner's psychology. That does not mean surrendering to every fear. Psychology can be trained. Knowledge can expand tolerance. Experience can improve judgment. But a strategy that ignores human behavior is incomplete. You are not a spreadsheet. You are the person who must continue following the spreadsheet when the world becomes frightening. This is why simplicity can be powerful. A simple financial system may be less optimized than an elaborate one. But if simplicity makes the system easier to understand, maintain, and trust, it can produce better real-world outcomes. Complexity creates more places for intervention. More intervention creates more opportunities for emotion. A complicated strategy can encourage the illusion that constant intelligence is required. Sometimes wealth is built through surprisingly few decisions repeated for a surprisingly long time. Earn, save, invest, diversify, avoid ruin, wait, adjust when circumstances genuinely change, keep going. The words are simple. Living them through decades of uncertainty is not, and perhaps this is the central insight of the psychology of money. Financial success is not primarily a competition to see who can memorize the most formulas. Knowledge matters, but behavior determines whether knowledge survives contact with reality. The person who understands compounding but becomes impatient may never experience it. The person who understands risk but becomes greedy may take too much. The person who understands diversification but becomes envious may abandon it during a speculative boom. The person who earns enormous income but needs to display every increase may never build wealth. The person who knows exactly what retirement requires but cannot define enough may move the finish line forever. Money reveals character because money creates choices under uncertainty. Wait or act, spend or save, risk or protect, compete or ignore, continue or quit, display or accumulate, borrow or delay, trust the forecast or prepare for its failure. There is rarely a perfect answer. There are probabilities, trade-offs, and consequences. The mature financial life is therefore less about eliminating uncertainty than building a relationship with uncertainty that you can survive. Keep enough margin that mistakes do not destroy you. Keep enough humility that luck remains visible. Keep enough patience that compounding has time. Keep enough independence that other people's spending does not become your financial plan. Keep enough flexibility that your future self can change direction. And define enough before the world defines it for you. Because the strangest thing about money is that accumulating more does not automatically make the game easier. More money can create more security. It can also create larger comparisons, larger opportunities, larger temptations, larger stakes. The psychological problem does not disappear when the account grows. Sometimes it becomes more important. A person who cannot tolerate enough with $10,000 may not discover enough at 10 million. A person who constantly compares at one income level may simply find wealthier people to compare with later. A person who takes reckless risks when poor may take larger reckless risks when rich. Money magnifies. It does not automatically teach. The learning must happen somewhere else. Perhaps it begins by recognizing that wealth is not primarily a collection of objects. It is not the car in the driveway, not the size of the house, not the photograph from the expensive vacation, not the number used to impress someone at dinner. Wealth is partly what remains after the visible choices. It is the money that was allowed to wait, the risk that did not need to be taken, the lifestyle increase that was not required, the emergency that became manageable, the opportunity you could accept because you had room, the job you could leave because you were not trapped. The time you could reclaim because your past self saved some resources for your future self. Seen this way, money becomes less about purchasing symbols and more about purchasing possibilities. And possibilities are difficult to display. That may be why they are so easy to undervalue. The richest financial outcome may not be reaching the highest number possible. It may be reaching a point where money occupies less psychological space. Bills do not terrify you. Market movements do not control your mood. Other people's possessions do not rewrite your definition of success. A setback does not destroy the plan. An opportunity does not require reckless risk. You have enough to think beyond the next paycheck and enough perspective to understand that more is not automatically better. Then money begins performing its proper role, not as the score of your life, not as proof of intelligence, not as a substitute for identity, not as protection against every possible future, but as a tool for resilience, a tool for choice, a tool for time, and perhaps when used wisely, a tool for creating enough distance from financial pressure that you can finally pay attention to the parts of life that were never really about money in the first place.